Great opportunity to meet with Ross Cameron, manager of the Emerging Markets Fund at Northcape Capital and the underlying manager for the Warakirri Global Emerging Markets Fund. Ross, welcome.
Thanks, Tim. Nice to be here.
Terrific to talk emerging markets and lots of questions. One of them in particular is if we look backwards before we go forwards and we look at the last 5-10 years, emerging markets have generally, certainly from an index point of view, been a bit disappointing.
Yeah, unquestionably. The short answer, two key reasons. One is a lousy index,
right?
And the second is a major headwind in a US dollar bull market. So on the latter, it's confiscated about 300 basis points per annum. The US dollar has been in a bull market really since the GFC. And the flip side of that is emerging market currencies have been depreciating. It's not always this case. If we look at the period 2003 to 2009, where US dollar was in a bear market, you had strong outperformance of emerging markets, 230% over that period relative to developed markets. But that's certainly confiscated. If we're backward looking, that's certainly confiscated performance. I think that's beginning to change as we've seen this year. And on the first point, the lousy index, if we go back historically, this is an index that was dominated by state-owned enterprises. Go back 10 years ago, Chinese banks, Petrobras. You always have a problem or a potential conflict of interest when you have government ownership, because those capital allocation decisions are not made purely to maximize shareholder value. There's other goals there, geopolitical, strategic, employment, and so on, and that's diluted returns. The other key factor, frankly, is the index is overly large exposure to China. Now, it's 30% of the index today, roughly, but China really is not an emerging market. It has poor demographics. The population has already peaked. So one of the lowest fertility rates in the world. China has a lower fertility rate than Japan, the poster child for bad demographics.
Yeah, absolutely.
Very high debt burden. And so really, we want to look at the emerging market returns ex-China, because China's not really where the opportunities are for smart, selective investors.
Do you find yourself underweight China in your fund as a result?
Yeah, we're extremely underweight China. I think, if we look at and this is a mistake that people often make. They look at the economy, which has been a great success story, let's be honest, and assume that's going to translate into equity returns. If we had a meeting in 2008 with a China economist, or a macroeconomist who said, over the next 15 years, the economy is going to grow high single digit. It's going to take hundreds of millions of people out of poverty. It's going to overtake Japan to be the second biggest economy in the world, on some metrics rival the US in terms of GDP. That person was correct. It was a fantastic macroeconomic success story.
Great argument for pile in, get into the market.
Exactly right, but that's translated into a loss of capital in the share market over the same period. Investment in Chinese shares is not the same as investing in the Chinese macroeconomic story, and that's a very important insight.
No, I can understand where you're coming from. So if you think about, when you think emerging markets, what are the key catalysts? You've mentioned the US dollar and the potential there for that to be going into a totally different phase.
Yep.
What other key catalysts are there that make the emerging markets popular for us?
So two main ones. The US dollar is very important because every time we've seen an extended US dollar bear market, it is always in history coincided with strong relative EM outperformance. Right. This year is no exception. EM's outperforming equity this year with a weak US dollar. And we have all kinds of metrics point to a sustained decline in the US dollar. The second is valuation. Even if we account for China, EM equities are just stupidly cheap. If you look at the long-term chart of EM equities relative to DM equities, it's really only twice in history we've been at this level. Last time was way back in the 1960s. And when we look at comparisons of companies that compete in global industries versus their developed market peers, the discount for the emerging market company, even though they're addressing the same market, is really spectacularly large. So there looks to be a real market mispricing and irrationality there. And the catalyst for that valuation gap to correct is the US dollar.
So if we see cheap assets, we see and believe, our choice to do so or not, that there's a tailwind coming. That in many ways is the perfect combination for an asset class that we want to be increasing in our portfolios. Are there, just quickly, short-term threats to that at all? Are there things that, if we went out tomorrow and started to increase our exposure, are there any short-term bumps that you see?
I think the short-term bump for all risk assets is geopolitical.
Yeah.
That's the thing that's changed dramatically over the last 20 years. I think we're now living, and look, the most recent display, where we had Putin, Xi, and Kim Jong-un all
Yes.
together, shows that we're living in a multipolar world.
Yep.
We've moved from a unipolar world where US was the only game in town to a multipolar world. Periods in the past where we've seen multipolarity have coincided with periodic geopolitical shocks. And we're going to see more of those. I don't think that's a specific risk for emerging markets, but that's a risk certainly for all risk assets. I don't think we've seen in our careers an opportunity like the current one for emerging market equities.
You really believe it's that much of an opportunity at this point?
The companies are dirt cheap. That difference between DM equity valuations and EM equity valuation, that elastic band is as stretched as we've ever seen. And it's very important as well to be selective, right? You don't just want to pile into passive here and you end up with 30% China, and you end up with exposure to those EM mega caps, the state-owned enterprises, the poor capital allocators. But if you could focus in on the really high quality companies here addressing either technology, so if we think of the CapEx side of the AI boom, that's dominated by emerging market companies like TSMC, SK Hynix, Delta Electronics, these kind of companies. Or if we tap into those kind of structural tailwinds of demographics, population growth, and so on, then in these areas there's some truly wonderful businesses trading on once in a career valuation opportunity.
Been great to hear some of that insight, Ross, and it's much appreciated. Terrific opportunity to catch up with Ross as the portfolio manager at Northcape Capital and the underlying manager of the Warakirri Global Emerging Markets Fund. Stuff for us to think about and consider whether we should be moving.